You think the bank is holding your money. Right now, this second, it isn't. Your money is not sitting in a vault with your name on it. It's already gone, lent out, earning someone else a return while you get paid almost nothing to have made it possible. That's not a scandal. That's not a loophole. That's the entire business model working exactly as designed. The average American savings account pays you 0.38% a year. The bank takes that same dollar and rents it out at 6-7%. You are the cheapest supplier in one of the most profitable arrangements ever built, and almost nobody notices they're in it. Here's what I'm going to show you. How a bank actually makes money. Why the thing you were taught in school about reserves quietly stopped being true in 2020. And why the safest-looking house in all of finance still collapses in a single afternoon. By the end of this, you will never look at your own bank statement the same way again. Because you're not the bank's customer. You're its cheapest supplier. There's an old joke bankers used to tell about themselves. They called it the 363 rule. Pay depositors 3%. Lend that same money out at 6%. And be on the golf course by 3 in the afternoon. Borrow low. Lend high. Pocket the difference. That difference, the gap between what a bank pays you and what it charges everyone else, has a name. It's called the spread. And it is the beating heart of every bank that has ever existed. The 363 rule was always half a myth, a bit of folklore from a more heavily regulated era. But strip away the golf and the punchline, and what's left is not a joke at all. It's the machine. Everything else a bank does is decoration on top of that one simple move. Rent money cheap, rent it back out expensive, keep the gap. I read through the FDIC's quarterly banking data so you don't have to. I looked at what banks actually pay depositors, what they actually charge borrowers, and what the regulators require them to keep on hand. What I found is that the story most people carry around in their heads about how banks work, the vault, the reserves, the safe box with your name on it, is not just simplified. In one crucial way, it's flat wrong. And the wrong part is the part that matters most. Let me walk you through the machine one layer at a time. Start with the number you already half know, what your money earns. As of 2026, the national average interest rate on a savings account in the United States is 0.38%. Not 3.8, not 38, 0.38. And that's the average. Plenty of the biggest banks in the country pay their depositors as little as 0.01%. 1 cent per year per $100. Now hold that next to what the bank does with your money the moment it lands. That same week, the average 30-year mortgage in America was 6.43%. So picture it cleanly. You hand the bank $10,000. The bank pays you $38 a year for it. Then it takes your $10,000, hands it to a home buyer, and collects $643 a year on it. $38 to you, $643 to the bank. On the exact same $10,000. Let that sit. The bank earns roughly 17 times more on your money than it pays you to use it. And you did the hard part. You're the one who earned that money, saved it, and handed it over. The bank just stood in the middle and collected the gap. And that 17-to-1 gap is the polite version. Some of the largest banks in the country pay as little as 0.01%. Run that number. $10,000 at 1 cent per $100 earns you a single dollar a year. $1. The bank turns around and earns $643 on it. That's not a spread anymore. That's a 600-to-1 difference, and it's completely legal, sitting inside millions of ordinary checking accounts right now. Why does the gap exist at all? Think it through and it's almost obvious. You need somewhere safe to put your money, and you need it liquid, reachable today with a tap. That need is the bank's leverage. It knows you're not going to move $15,000 to chase an extra few dollars a year. So it pays you the lowest rate that keeps you from leaving and no more. The borrower, meanwhile, has no cheaper option than the bank, so they pay the higher rate. The bank isn't earning the gap by being smart. It's earning it by standing in the one spot where both sides have nowhere better to go. That gap, spread across every dollar a bank holds, has an industry name, net interest margin. It's the single most important number in banking. And in early 2026, across every FDIC-insured bank in the country, the average net interest margin was 3.31%. That sounds small. It isn't. Run it on your $10,000 and the bank clears about $330 a year clean margin. after what it pays out, on money that was never its own. Now multiply that by trillions. American banks reported over $80 billion in profit in a single quarter of 2026. $80 billion. In 90 days. Not for a year, for 90 days. That's the machine running at scale, and every dollar of it starts with a deposit somebody thought was just sitting there. And here's the part that reframes everything. The bank is not making that money by being clever. It's not outtrading anyone. It's not taking some brilliant risk. It is making that money by sitting between you and a borrower and charging rent on the distance. You are the raw material. Your deposit is the cheapest input in the entire supply chain. And the whole business is engineered to make sure you never think of it that way, because the moment you do, you start asking why you're only getting $38. That's the spread. That's layer one. But the spread only explains how much the bank makes. It doesn't explain the strangest part of the whole arrangement, which is where your money actually is right now. Let me ask you something. When you deposit money, how much of it does the bank have to keep? If you went to school in America, you were probably taught something like this. The bank keeps a fraction, say 10%, in reserve and lends out the rest. Keep a tenth, lend 9/10. Fractional reserve banking. It's in the textbooks. It's on the exams. Here's the thing almost nobody updated. That's no longer true. On March 26, 2020, the Federal Reserve reduced the reserve requirement for every depository institution in the United States to 0%. 0. Not 10. Not 3. Nothing. For the first time in modern American history, there is no legal minimum amount of your deposit that a bank is required to keep on hand. Understand how big a break that is. For most of the last century, that number lived around 10%. Keep a tenth, lend the rest, that was the law, and it's where the whole fractional reserve idea comes from. There was even a tidy piece of math that came with it, the money multiplier, that described how one deposit could ripple out into many loans across the banking system. All of it built on that reserve fraction. And then, one Thursday in March, the fraction became 0, and the textbook quietly became a history book. This barely made the news. It arrived in the same week the world was shutting down for a pandemic, and it slid right past everyone. But think about what it actually means. The mental model you're carrying, the bank keeps a safe slice of my money in reserve, is describing a rule that was switched off years ago. So where is your money? It's out. It's working. It's in someone's mortgage, someone's car loan, someone's business line of credit. The dollars you deposited this morning are not in a drawer waiting for you. They are, at this moment, spread across other people's debts, earning the bank its spread. Your account balance is not a pile of cash. It's a promise, a number on a screen that says the bank owes you that much whenever you ask. That's the open loop I planted at the start. Your money is not in the bank right now. And now you know it's not an accident or a scandal. It's the design. Now, before anyone panics, this does not mean your money is gone or unsafe. Here's what actually replaced the old rule. Instead of forcing banks to hold reserves, the Fed now pays them interest to do it voluntarily. It flipped from a mandate to an incentive, from you must keep this to we'll pay you to keep this. And banks do keep reserves because they still need cash on hand every single day to cover the people walking in and tapping withdraw. So the vault isn't literally empty. It's just that nothing legally requires it to have any particular amount in it. And your deposits are insured by the FDIC up to $250,000 per depositor. The system has other guardrails. The point is not that the vault is empty and you should be afraid. The point is subtler and stranger. You believed the bank was a place that stores your money. It is actually a business that borrows your money from you at the lowest price it can get away with and immediately lends it back out at a higher one. The reserve was never the point. The spread was always the point. Which brings us to what you actually are in this relationship. Not the customer, the supplier, the cheapest one they have. Think about how a normal business treats its cheapest supplier. It negotiates hard, pays as little as it possibly can. It keeps the relationship comfortable enough that the supplier doesn't walk away, but never generous. The supplier's job is to hand over the raw material at the lowest price and be grateful for the convenience. Now read your own bank statement in that light. The low interest rate isn't an oversight. It's a price, the price the bank pays for its raw material, set exactly as low as it can go while keeping you from leaving. The slick app, the branch on the corner, the friendly name, those aren't gifts. They're the cost of keeping a supplier happy enough to keep supplying. And here's what makes it work so beautifully. Most suppliers know their suppliers. They send invoices. They negotiate contracts. You don't. You've been trained to feel like the bank is doing you a favor by holding your money. So you accept $38 on $10,000 and say thank you. You're not being naive when you do this. You're doing exactly what the arrangement was designed to make you do. Every touchpoint reinforces it, the reassuring branch, the word savings, printed on the account, the little animation when your balance updates. None of it says supplier. All of it says client, valued, protected. Your brain files the bank under places that keep my things safe. Right next to a safe deposit box, when it belongs under businesses I sell a product to at a discount. That's not a failure of intelligence. It's a triumph of framing. The whole system is built so the obvious question, what am I actually getting paid here, never quite forms. This is the same move you'll recognize from everywhere else in your financial life once you see it. The app that's free because you're the product. The subscription that auto-renews because friction keeps you paying. The rewards card that makes you spend more to earn less. In every one of these, someone quietly reclassified you from customer to supply and kept you comfortable enough not to notice. The bank just did it first and did it best. It convinced an entire country that being underpaid for your own money is a service. You're not the bank's customer. You're its cheapest supplier. And the convenience is the price you pay for not noticing. Let me make this concrete. Let me tell you about Derek. Derek is 34. He's careful with money. More careful than most people his age. Every 2 weeks, his paycheck lands in his checking account, and he moves a chunk of it straight into savings. He's built up about $15,000 that way. Took discipline. He's proud of it, and he should be. Every so often, Derek opens his banking app and looks at that number, $15,000, sitting there, safe. When the world feels shaky, that balance is the thing that lets him sleep. It feels like a wall between him and disaster. Here's what Derek doesn't see. The moment each deposit lands, the bank puts it to work. Right now, a piece of Derek's $15,000 is inside a stranger's mortgage across town, earning the bank 6-point-something%. Another piece is in someone's auto loan. Another is financing a small business he'll never hear about. Derek's wall is not a wall of cash. It's a promise, backed by a portfolio of other people's debts. And for the privilege of turning his savings into their engine, the bank pays Derek about $57 a year. On $15,000. $57. Meanwhile, that same $15,000 is generating close to $1,000 a year in interest for the bank as it moves through the loans it funds. That's the crisis in Derek's story, except it's a quiet one. Nothing breaks. No alarm goes off. Derek never gets robbed. He just slowly, without ever being told, becomes the least paid participant in a deal he thought he was winning. The safety he feels is real in one sense. His deposits are insured, he can pull the money out and completely upside down in another. He thinks he's the client being served. He's the supplier being sourced. Now, here's where Derek's story turns. And it's not the turn you might expect. When Derek finally understood this, he didn't rage quit his bank. He didn't stuff cash under his mattress. Nothing about the mechanics is illegal or even unfair exactly, it's just unseen. What changed was the story in his head. He stopped thinking of his bank as a guardian and started thinking of it as a counterparty. Someone he's doing business with, not someone doing him a favor. And once you see the relationship clearly, once you know you're the supplier, you start asking supplier questions. What am I being paid for my raw material? Could I get a better price somewhere else? Is the convenience actually worth the discount I'm giving up? Derek didn't need a finance degree to ask those questions. He just needed to stop believing the story the arrangement was telling him about himself. Now, you might be thinking, okay, but isn't this fine? The bank takes a spread, sure, but I get safety, I get insurance, I get to move my money with my thumb. Isn't that a fair trade? And honestly, often, yes, this is not a villain story. The spread pays for real things. The FDIC insurance that protects your deposits, the fraud protection, the ability to send money across the country in seconds. A world without this arrangement is a world where you keep cash in your house and pray. The bank's business model is not a scam. It's a service with a price, and the price is mostly hidden inside the spread. The problem isn't that the trade exists. The problem is that you were never shown the terms. You were taught the bank stores your money. You were not taught that it borrows your money. And that missing word, borrows instead of stores, changes whether you're a passive holder or an active participant who could, if you wanted, shop for a better deal. Because here's the thing. The gap between the average savings account and the best available ones isn't small. While the national average sits at 0.38%, there are federally insured accounts paying several times that. Same insurance, same access, wildly different price for your raw material. The suppliers who know their suppliers go find those. The ones who think their customers leave the difference on the table year after year and call it loyalty. There's one more thing about being a supplier to a bank that you need to understand. And it's the answer to the second question I opened with, why does the safest looking house in finance still, sometimes, collapse in a single afternoon? Because the bank doesn't just borrow cheap and lend expensive. It borrows short and lends long. Your deposit can be pulled out today, this second, with a tap. But the mortgage the bank funded with it is locked in for 30 years. The bank is standing on a mismatch, money that can leave instantly, funding loans that can't come back for decades. As long as everyone stays calm, the mismatch is invisible. The moment everyone wants their money at once, it's fatal. In March of 2023, the world watched this happen in real time. Silicon Valley Bank was the 16th largest bank in America. $209 billion in assets. It had done exactly what banks do. Taken its depositors' money and put it to work, in this case in long-term bonds with an average duration of around 6 years. That's the borrow short, lend long mismatch made concrete. Deposits that could leave any second, parked in bonds that wouldn't mature for years. Then interest rates rose fast, and the market value of those older, lower-rate bonds fell, leaving the bank sitting on something like $15 billion in unrealized losses. Paper losses, invisible right up until the bank had to actually sell. And its depositors, mostly tech companies, all talking to each other in the same group chats, got nervous at the same time. On a single day, March 9, 2023, customers tried to pull out $42 billion. In one day, that was nearly a quarter of everything the bank held, demanded back in a matter of hours. The bank did not have $42 billion in cash because no bank does. The money was out, working, locked in loans and bonds that couldn't be sold fast enough. The mismatch became visible, and once it did, the whole thing came apart in roughly 44 hours. Solvent on Wednesday, seized by Friday. The CEO had gone on a call urging everyone to stay calm. Hours before regulators took the bank. 2 weeks later, what was left was sold off to another bank, First Citizens, for the pieces. It was the second largest bank failure in American history, and it happened at the speed of a group chat. Sit with the strangeness of that. A bank does not fail because it ran out of value. Silicon Valley Bank's loans and bonds were still worth enormous sums. It failed because too many suppliers tried to reclaim their raw material at the same moment, and the raw material had already been spent on something that couldn't be returned on demand. That is the deepest truth about your deposit. The safety was never about a vault. It was always about confidence, the shared belief that not everyone will ask for their money back at once. The vault has been mostly empty by design for years. What holds it up is that we all agree to look away. So what do you actually do with this? Not panic. The system has real protections, and for money you might need tomorrow, an insured bank is exactly where it belongs. This is not a reason to distrust banking. It's a reason to participate in it with your eyes open. Here's the shift. Stop asking, where is my money safest, and start asking, what am I being paid to supply it? Those are different questions, and only the second one is under your control. Know your number, the actual interest rate you're earning right now. Most people have no idea what theirs is. Go look. If it starts with a 0.0, you're supplying your raw material at the lowest price on the market, and someone is very grateful. And understand what that discount actually costs you, because it isn't rounding error money. The gap between the average account at 0.38% and the best federally insured accounts, which have been paying several times that, is real dollars every year on the same insured accessible deposit. On a serious emergency fund, that's the difference between a few dollars and a few hundred for identical safety. The suppliers who know their suppliers go find that price. The ones who think their loyal customers leave it on the table and never see the invoice, because there isn't one. The cost of not looking is just quietly absorbed by you. And carry the bigger lesson out the door with you. The bank isn't the only business that quietly turned you from customer into supply. Once you can see the move, cheap input, expensive output, kept comfortable enough not to look. You'll see it in the app, the card, the subscription, the feed. The bank just taught you the shape of it. You started this thinking the bank holds your money. Now you know. It borrows your money from you at the cheapest price it can, lends it back out at the highest price it can, and keeps the gap. The reserve you were taught about was switched off in 2020. The safety you feel is confidence, not cash. And the whole thing runs on you never quite realizing which side of the table you're sitting on. Your money isn't in the bank right now. It's out there in 100 strangers' debts, earning someone else a return by design. And the safest house in finance is only ever one bad afternoon of everyone asking at once away from falling down. Both of those are the same fact, seen from two angles. The bank's strength and its fragility are built from the exact same thing, your deposit already spent. None of this means run from your bank. It means see it for what it is. A business you supply. A counterparty, not a caretaker. You're not the bank's customer. You're its cheapest supplier. The only question left is whether you're going to keep giving your raw material away for $38, or start asking what it's actually worth. If this changed how you see your own bank statement, subscribe. This channel is about seeing the machine you're already inside of.